That's where we'll start here with Matt Boss, JPMorgan retail analyst. Matt is the Extel Analyst Hall of Famer. He has an overweight rating on Gap, the new institutional investor. Welcome back. I mean, Gap, I saw the new line from Zach Posen for Old Navy. The stock, it's a turnaround story. Stock's down 20%. Is it all just tariffs?
Yeah, so thanks for having me back. The Gap stock today is not trading on fundamentals, meaning you had your third straight quarter, mid-single digit plus same-store sales at core Gap, and Old Navy was in the low single digits. And they talked about last night on the call, 8 to 10% multi-year bottom line flow through at low to mid-single digit same-store sales. But to your point, what's in the stock today is $150 million of incremental tariffs at a low double-digit multiple. That's $5 to $6 of equity value that the market's taking out. Where we think that's wrong on the group as a whole is the Gap, for example, is dual source. They'll exit this year with 3% China. On average, our group today has high single-digit China impact, but that was 20% in 2019. So the ability of companies not only to mitigate this year, some using price and some not, but on a multi-year basis, I don't think that this is a capitalizable event that we should be taking out of equity values today.
So you're a buyer on the weakness.
Yeah, we think fair value is probably in the mid-30s if they can execute this turnaround. And so pullbacks like this are opportunities.
We're also starting to see really who are the retail winners and losers in this environment, who has pricing power, who is just resonating and providing merchandise that the consumers want right now.
Yeah, and I think you nailed it on the environment. So I think for the better part of the last 18 months, we've been calling this a selective recession. And I think that selective recession whereby the lower income consumer is struggling a lot more than the wealth effect that's been benefiting the higher income consumer. The dollars are out there. The consumer is remaining resilient, but they are being really selective in what they're choosing. It's probably the largest bifurcation between winners and losers that I've seen in almost 20 years of doing this. And so on that winners list, to me, it's the Coach branded Tapestry, nearly 20% growth. Ralph Lauren, they're executing after nearly a 5-year turnaround. You have the Amer Brands portfolio that's doing really well. Birkenstock is another winner. Levi's has executed a turnaround. Urban Outfitters, first time in nearly a decade where every one of those brands is in positive territory. We talked about the Gap. So, and then
Abercrombie,
I think
is that on your list?
Well, I was going to say I think off-price is also really well positioned in this in terms of value and product. And the two show me stories I think would be Abercrombie and Lululemon. I think those are two really interesting show me stories where I think there's been normalization in both. Abercrombie, coming off of 2 monster years of top line, is giving back some of the gains this quarter and next. And Lulu had 20% top line growth for 2 years straight coming out of the pandemic when everybody stayed at home. And I think now into the back half of the year, the newness restored, the leadership team in place, Lulu goes back to what I think that industry can grow at, which is mid-single digits multi-year.
Is their China exposure also as dramatically decreased as Gap's?
Yeah, I think on average, again, I think we're down to high single digits for the group, and Lulu is dual sourced on every single item that's in that store. So you have exposure in year one, but then what companies are waiting for is let's see what happens in mid-July and what do the tariff rates look like outside of China. So people have a game plan and contingencies in place. They're just waiting to see where to move and how quickly to do it. The other thing that they're waiting on is pricing. And so you have some companies that have announced, I'd say on average today, low single digit to mid single digit price increases that I heard you before that probably are going to hit middle of May and into June. But other companies are saying we're going to wait and see. So off price, we were in Framingham and met with TJX this week. They were saying, look, we see this as an opportunity to potentially take share. They don't need to actually pass through the price to offset because they can back it into the buy. But if they see the consumer opportunity, depending on the category, in some cases, there'll be flow through in the model. In some cases, I think the value spread goes wider and they take market share.
I'm curious about turnarounds. You mentioned a number of them. They seem to figure prominently in terms of an increase in the stock price when they get it right. Is there a unifying principle, something that investors can look for in terms of when a management team takes over and you can tell that they're going to be successful somehow in this turnaround?
Yes. So it starts with product improvement, but it has to coincide with channel clean inventory. So I think the key to it is if you look at the Coach turnaround, they're 90% direct to consumer. They got out of the off-price channel they got out of the second-tier department stores. Ralph Lauren, almost the exact same playbook. But the key to both of them was they executed through product improvement, bringing more make, more quality. They also upscaled that customer base. They're now sourcing younger customers that transact more frequently and higher income customers that are buying at higher AURs. So the new customer acquisition that's coming in is greater than the leaky bucket side of the customer basically that they fired. But I think the last piece to this is if it intersects with value proposition, that's the sweet spot today. So Coach and Ralph would say that the value spread relative to luxury is the widest in the company's history today. If you think about it this way, one of these luxury handbags goes up 5% and a Coach bag goes up 5%. That value spread actually goes wider when you think about the base. So I think companies that have that increased swim lane are really well positioned today to take increased market share.
Versus the luxury players like a Chanel, which just went way high, all the way up to the ceiling. Are there any losers? I mean, you mentioned only winners.
So if you're in the midst of a turnaround and you didn't come into this clean, I think it could just take a lot longer with the disruption. So I would put Nike in that camp where, look, this was going to be a multi-year turnaround. This still has excess inventory to clear and a number of structural components to get through over the next few years. I look at some of the smaller companies that are battling some of the larger, like an Under Armour, a Michael Kors in the Capri portfolio. The department stores, I think, are more structural and sitting on thousands of stores that probably need smaller store bases, which means a smaller EBITDA base over time. So some of the valuations in deep value territory, I think you'd need to take a closer look at what's the actual underlying structure, and they may not be as cheap relative to those that have been executing multi-year turnarounds. And I think that's the key. The companies that are positioned today for durable drivers, it was work that they have had in process for 3 to 5 years.
Gap comes off the lows, as Matt Boss says bye. Thank you very much. We got a lot in there.
Great
Appreciate
to be back.
it.
That's good.
Matt Boss.